Great. Ladies and gentlemen, thanks so much for being with us this afternoon. We've just been informed that unfortunately our colleague from Sudan will not be able to join us. He has an emergency to attend to. So please accept his regrets. But with that said, I think that we can get started if the panelists agree. Excellent. So thank you very much for being here. I'm very pleased to welcome you all to this side event on the margins of the Intergovernmental Preparatory Committee meeting for the 5th UN Conference on Least Developed Countries. My name is Laura Sennett, and I am the Policy Specialist at UNCDF. Please allow me to give a brief introduction before handing over to the moderator. At UNCDF, we offer what we call last mile finance models that contribute to unlock public and private resources to support local economic development and achieve the SDGs in the LDCs. As we are all well aware, LDCs typically face significant challenges in mobilizing the financing needed to achieve the SDGs, including especially private financing. According to our recent publication on blended finance in LDCs, which we produce in collaboration with the OECD, between 2012 and 2018, only 6% of all private finance mobilized through blended finance approaches went to LDCs. And even that 6% was highly concentrated in just very small number of sectors, countries, and transactions. As a result of COVID-19, we've also seen further significant drops in all private capital flows to LDCs, including foreign direct investment. So there is an urgent need to take up a more systemic look at what needs to be done to increase access to investment capital that can allow LDCs to recover and build back better. The Addis Ababa Action Agenda and the 2030 Agenda both identify the need for multiple sources of finance to work together effectively and in new combinations. Yet the international financial architecture is not well designed to directly support small ticket size, higher risk transactions that nevertheless will be the key to achieving transformative impact at the local level. Against this context, it is critical that the LDC5 Conference delivers concrete solutions that make finance work for the LDCs and leave no one behind. The objective of this session is therefore to explore the suite of financing and de-risking resources and instruments that catalyze additional resources to help fill financing gaps and support transformative investments in LDCs. Before I introduce our esteemed moderator, please allow me to highlight a few logistics for everyone. We have French interpretation available. Please click the interpretation button at the bottom of your Zoom screen. And for the question and answer segment, please post your questions in the Zoom question and answer box, and we will attempt to respond to as many questions as possible. So now to moderate this session and to provide some further introductory remarks, I am very pleased to introduce Dia Martin. Dia is a managing director on the social enterprise finance team at the U.S. International Development Finance Corporation. She also leads the portfolio for the Impact and Innovation Program, which is focused on financing scalable, earlier stage projects that are highly developmental. It is a real pleasure and honor to have you here. Dia, over to you.
Thank you, Laura. I am absolutely honored to participate in this panel with you and all of the esteemed panelists. I want to thank everyone for joining us here today. We look forward to a very great discussion from our panelists, and then we will engage in questions and answers from the audience as well. The title of this session is Supporting Transformative Investments for SDG Achievement in LDCs. So the question is, what is needed to increase the finance going to the poorest countries in order to help them deliver the sustainable development goals? And I'd like to ask our panelists to think about, innovate, and to take risks. This is a safe space, and we want to hear some new ideas. We want to really test and challenge each other. There's some good news. The ODA figure for 2020 is at an all-time high of $161.2 billion US dollars in 2020. This is up 3.5% in real terms from 2019. This was a small but important increase of 1.8% going to the least developed countries. However, while there is good news, there were fears that ODA would collapse this year, and it certainly hasn't done that. The less good news is that we still have a long way to go, as these numbers are still far from the trillions that are required to achieve the SDGs. So the question is, how can we get there? How can we use ODA, including the use of blended finance and other innovative finance instruments, to catalyze other types of finance to come into the LDCs? It is working extremely well in some countries, but the least developed country markets remain incredibly challenging. And I hope one of the things that we'll talk about today is what we can do together to make it less difficult for this capital to go into these markets. An example is at the DFC, we have implemented the Roadmap for Impact. This is a 5-year strategy to catalyze $75 billion to maximize development impact while creating strategic and sustainable growth. We focus on key priority sectors such as technology, infrastructure, financial inclusion, healthcare, energy, agriculture and food security, and the WASH sector. Part of this impact, this Roadmap for Impact strategy, is to prioritize low and low middle income countries. Our focus is to have at least 60% of all projects that we do in these low income and lower middle income countries, and also in fragile states. And the Portfolio for Impact and Innovation program that I lead is a fundamental part of that, where we support earlier stage SMEs in scaling and reaching their growth milestones for a sustainable social impact. This conversation today is an opportunity for all of us to take this agenda forward for all of our organizations. The way the conversation will flow is I will introduce each panelist as I ask the question of them, and we're doing this in the interest of time. I hope to be able to get through 2 rounds of questions, and then as Sarah said, we will open it up for questions from the audience. If there's time, we'll do a quick fire round to the panelists to see where we've concluded the conversation. Without further ado, it's my privilege to against investment and development.
Dia, can you hear us? Dia, are you able to hear us? I think you're.
Are you able to?
Yes, I think if you turn off your video, maybe. It says that the bandwidth is low, so we're having trouble hearing you.
I will join from another source.
Okay. Dia, why don't I can take a minute to introduce all of the panelists, and that way while you rejoin, we can use this time for that, if that's okay.
Sure. Am I clear at this point, or do you still want to?
No, you are. Please go ahead.
Okay, thank you. Apologies for the technological difficulties. I will just start again. I'd like to introduce Ms. Preeti Sinha, who's the Executive Secretary at the UN Capital Fund. She is a globally experienced investment and development banker with a 30-year track record associated with raising and managing institutional, public and private development capital. Preeti, as part of the LDC5 preparatory process, the LDCs have called for a dedicated financing mechanism that delivers catalytic investment capital for SMEs and small investment projects in African LDCs. Why do you think this is important, and what role can UNCDF play?
Thank you, Dia, for that very pertinent, very important question. So I am very happy to respond, and I was thinking whether to take it from origins to current, and so your question is very much the current, or to take the current and go backwards. So maybe just in interest of the audience, let me start a little bit with the origins to give a context of UNCDF. So UNCDF has been set up in 1966 by the UN member states, and the mandate was to finance the least of the developing countries, which we have done proudly now for about 50 years. And what the other unique factor when setting up CDF was they gave us the authority to do grants, TAs, loans, and guarantees. So with these products, we are kind of a hybrid between a development agency and a development finance agency, a unique kind of positioning for us within the UN system, in particular, the only entity to do loans and guarantees. So while we've been doing that, what we see is we do a mix of public and private projects. So we finance the governments, and we do that at a subnational level through our local development finance. And we find that being closer to the problem at a municipality level is interesting for us. And we also finance private sector, for example, SMEs across the LDCs. And our mandate is on these 46 LDCs. We focus very strongly on those. So in answer to your question, the LDC5 process is going on right now. It will conclude in January next year in Doha. And that will set the 10-year plan, program of action for the LDCs. So we'll hear from the LDCs what they want. So in the meantime, we are very closely working with all the LDCs. And the point is that beyond that valuable ODA that you mentioned, let's round it to 152 billion, we believe that there is no scarcity of private capital. So there's about 4 trillion of private capital in private equity, which is bound to increase, we think maybe to 9 trillion. And as you know, there's around 400 trillion in private wealth across all savings and institutional assets. So the question is about the vehicle, the dedicated vehicle is how do we obviously bring in some of that private capital to come alongside the ODA. So it's about building bridges for us. And this is supported by the recent UNFFD report. It's called Financing for Sustainable Development report. And the two criteria there were use public money, domestic and international, to crowd in private money. And the second one was create investable projects, a pipeline of projects that would, again, attract this private capital. So I think, again, based on our history on the work we've been doing, we have a good sense of the economies of these LDC countries. And we work, as I said, on the market development aspect. So we use our grants and TAs to seed the market, seed enterprises, seed projects. And then we use the loans when the projects are a bit bigger and SMEs are a bit bigger. And the guarantees are very useful entities, again, and very useful instruments to help attract private capital. In this context, we've gone ahead and structured two blended funds. So the first one's called Build. It's a $250 million fund with Bamboo Capital in partnership, and it has first loss, it has mezzanine, and it has senior. And this will invest exclusively in SMEs in the LDCs. So the second facility is also very interesting. It's with Meridian Capital, Meridian Partners out of Paris, one of the largest global infrastructure funds. And it's in our municipal work, and we call it the International Municipal Investment Fund, a 350 million euro fund to invest in municipal projects. And I said the municipal can be public and private, largely debt, some equity as well. So having had that experience, our objective for LDC5 is that either of these vehicles could reach final close and then expand to become bigger, or if there is a need for a consolidated fund that could also be developed. So we feel developing a very large de-risking blended fund, I think leveraging perhaps the Build fund to make it bigger and or other funds, that this is the way to bring concessional and non-concessional financing together and then therefore finance the LDCs. So let me stop there and just give you that insight for now and look forward to further discussions.
Thank you so much. I think that's very exciting, the ability to bring together various actors and partners to finance development, and especially to be able to go down and reach those SME businesses that are so important for development and sustainable impact in the countries that we work in. I'd like to move on at this point to our second esteemed panelist for today. Her name is Ms. Tariye Badageshan. She is Managing Director and Chief Executive Officer of Arm Harith Infrastructure Investment Limited. As an investment professional with over 20 years experience in finance, principal investments in infrastructure, Tariye has mobilized over $3 billion of capital for infrastructure projects in Africa. She was also recently appointed into the United Nations PRI Advisory Committee and the United Nations Technical Working Group on Finance and Investment. So my question for you is, what is an example of an investment that you have made in an LDC? And what were the factors that contributed to making it a success?
Thank you, Dia. And very happy to be here today. Thank you for inviting me to the panel. Good to see you, Preeti and Laura and everyone. It's always great to talk blended finance, especially for least developed countries and developing economies. Can I just confirm you can hear me? Okay. So I think it's important that we look at examples of financing in least developed nations from two lenses. And I think Preeti has lined this up to some extent by referring to public sector oriented financing and then private sector oriented financing in terms of the types of projects. And then there's, of course, PPP. And I will speak from my vantage point, which is infrastructure, in that I've been investing in infrastructure in Africa for just about 15 years now, and have invested in all sorts of real assets in the larger economies and some of the smaller economies, done both debt and equity. So I've sort of seen the evolution of the financing landscape and have a sense of what's been working and what are some of the gaps. And I'd like to point to, I guess, a couple projects or a couple financings that are quite interesting. So there's sort of an increasing number of least developed countries in Africa. So for example, Benin, for example, Guinea, that are, and I'll use the Benin example, which is a case where a small African country has been able to raise dedicated public finance for infrastructure. And so they had a very successful road financing program that was tied to various forms of public proceeds. And it was backed by a sovereign guarantee. There were certain laws that were put in place. But they also had backing from development finance institutions in the form of cross guarantees. And one of those institutions was also an insurance fund, like a guarantee fund. So there's an emerging number of guarantee funds that specialize in cross guarantees. And so these sovereign guarantees from least developed countries are not enough. That's one of the big takeaways. And there has to be this network of the sovereign guarantees, enhancements to systems that reduce the risk of a sovereign guarantee crystallizing, which means that for a project or a road program, for example, you need to have some form of levy base or a tax base or some kind of revenue stream that can to some extent be securitized or to give comfort. And then in addition to that, a layering of some sort of insurance instrument. And this is a form of blended finance that happened at the project level. And by virtue of those various wraps, that particular instrument could be placed into this typical $4 trillion financial market, where your standard financial institutions were able to participate. And so the first issue was the enhancement of a non-investment grade LDC into an investment grade instrument. And that's really what we're trying to get to, is we're trying to enhance the risk profile, especially at the project level. And so there have been some very successful cases of that. And I think we're beginning to see a few more of the LDCs do that. Now, there's also the private project and the landscape of private projects. And there's a couple that are quite interesting. There's the Djibouti wind farm. So that's been, that's a large scale wind power project. And there's also been, there's also an interesting, not too clean project in Liberia around tanking solutions and storage. And those projects, one of them does have a sovereign linkage and the other had less of a sovereign linkage. But I think what's critical here is scale. And the challenge that a lot of LDCs have is that the scale of the country is low, the number of the companies you can invest in are small, the project sizes are small, the financial amounts are small. And the smaller the fund size or the project size, the more challenging it is. And I think what we're seeing is, to the extent that an LDC can strategize, and this is speaking from an infrastructure perspective, so we're not, there's definitely an SME lens, but to the extent that LDCs can prioritize, aggregate, and centralize core economic infrastructure or requirements that can achieve a form of scale, so that you can talk about a core infrastructure that's serving the country at a $40 million mark or a $50 million mark or a $30 million mark. That's very helpful to be able to attract private capital. So let me leave it at that. There's a lot to talk about, lots of panelists, but I've just touched on sort of a public structure of blended finance, and then, what are ways to go into more private and specific projects, and how to get them to get to some level of scale. And I just want to touch on one last thing, which is around aggregating among LDCs. So there's also another pretty interesting project. This one is actually in a forestry space, which is sort of the aggregation of forestry assets across 3 or 4 LDCs with similar topography. And so this issue of how do we achieve scale, Bamboo Capital doing some really interesting things around scaling capital and scaling opportunities. And these are some of the issues that we need to sort of think through when we're trying to allocate capital to LDCs.
I really appreciate your comments, and especially coming from a DFI, the ability of aggregating and scaling to increase the ability of both public and private sector investors to invest in projects is really important. And the idea of the guarantee and being able to move a product along or a project along the risk cycle and to mitigate risk is really important, and definitely an enhancement to bring in investors. So thank you so much for those comments. Finally, we are joined today by Magnus Lekander. He is the General Counsel and Head of Group Operations at East Capital International. Magnus is a specialist in emerging and frontier markets and has been involved in complex M&A and investment structuring targeting these regions. Magnus, the objective of a catalytic fund for the LDCs would be to mobilize sustainable private investments that advance the SDGs. How could a catalytic financing mechanism help private investors to do more investments in LDCs?
Hi, everyone. Very, very honored to be invited into this forum. And just to tell you a little bit where I'm coming from. I'm representing an institution where we've been investing in emerging and frontier markets since the late 90s. And we actually started off in Eastern Europe and then expanded globally. So in a way, we have not really been targeting the LDCs directly, but we've surely gathered a lot of experiences throughout these years, particularly when we're looking at the Eastern European countries and the former Soviet states and how they developed from having a simply non kind of financial infrastructure at all, and then gradually developing this. So to some extent, it could be kind of an interesting parallel, although the conditions might be quite different. Then moreover, I could just add that, I mean, we're investing in primarily public equity, but we have done real estate and private equity in these countries as well. But I think what's going on now is also very interesting because it's a lot of momentum and interest in various networks. I mean, we're so much engaged in Swedish Investor for Sustainable Development. You might have heard of the Global Investor for Sustainable Development, where you also are participating from the UN side. And it's just so, inspiring to see that, we can see there's so much aligned interest now. There's so much capital out there at the moment, which just urging and waiting to invest more aligned to the SDGs, right? And I think for the challenge to push it in the right direction is really to find this the correct vehicles. And just to tag on what Tanya already said, it's all about size, right? It's a size game for many institutions out there. It's about fitting their portfolios. And they're managing a lot of assets, and that's kind of both the beauty and the challenge with the existing financial system is that it's very scalable. In a way, if you once you tap into a pocket, you can scale very quickly. At the same time, it also puts challenge if that scale is not really matching the demand side. And I think that is what has been identified here. You need to find that intermediary vehicle which could pool a lot of assets and then channel it into the right project, which could be quite small. And during this work that we've been doing in these networks, there's been a lot of creative discussions about how would you do this, how would you structure this kind of vehicles, how could we make it fit these large asset owners to allocate assets to it. And I think I have a number of kind of observations from those discussions. First of all, I mean, when it comes to instrument, if you would like to have something which is truly catalytic, choose something which is building on already an existing format. So, for example, you all know the success of the green bond, for example, and now we have other kind of blue bonds or SDG bonds or COVID-19 bonds. I mean, once you have a recognition of a particular setup, I think you can tweak it and adapt it for your needs. So I think that's one thing to build on that. I think also the importance of the NDBs as an intermediary and some kind of conduit in channeling this capital could actually be quite attractive. The development banks are somewhat in a unique position as I see it, because both they are very solid and reputable and recognized issuers of instruments. At the same time, they have the local presence in these regions where these capital will eventually be going into. And then as a third kind of observations is what we've discussed so far. It's of course the blended finance solutions, where, I mean, as we speak, there are discussions ongoing how this could actually be done, and it's led through this network where you could, in this particular project I have in mind, is geared towards infrastructure and on a global scale. But that setup, I think, once it gets this kind of recognition among these asset owners, I think it could be easily used as a template also for new ideas. So when it comes to catalytical vehicles, I mean, there's a lot of good creativity out there at the moment, and it's just to go with the flow, I would say.
Thank you so much, Magnus. One of the takeaways I have is that idea of adaptability and not necessarily reinventing the wheel, but adapting instruments that are already there that can be used or tweaked for use in our markets. I appreciate that perspective. At this point, I will turn a question back to Preeti. I have a question on how can innovative models of finance be used to mobilize capital for small ticket sizes, transactions that are seen as higher risk, but these are the transactions that will be key to achieving transformative impact. And what we would need to scale up these investments or to scale up instruments to support these types of transactions.
Thank you, Dia, and really interesting comments by all the panelists. So in answering that question, I highlighted 4 or 5 points here that I'd like to make. So I would agree totally with Arya and with Magnus. It's the aggregation that we need to consider. So for us as well, just to say, we have 3 practice areas. So we have the inclusive digital economies, the local transformative finance, that's the municipal work, and then the investment platform where the loans and guarantees and blended fund are done. So the portfolio we think is interesting to aggregate first is on solar energy. So I think we would like to take about 5 to 10 solar projects and put them into a kind of portfolio and look at whether a climate investing fund or perhaps a clean tech fund could be interested in looking at that. And the way we look at our pipeline, so we've been actively consolidating our pipeline in these countries, is from the 50 to the 5 million investment. So this is called the missing middle because it's too big for microfinance and too small for typical any other class of investors. And then there's the mid-size from 5 to 25 million, which could have many takers, including impact investors. And then the transformational ones over 25, which could be larger infrastructure, larger planning projects where perhaps we play a convening role because we help the government build capacity to create the project, but then I'm sure there'll be lots of MDBs and partners that come in. So in that context, taking 5 to 10 of the smaller projects and creating a portfolio and looking at solar, it's the direction we are heading. So more to report on that, and maybe, of course, in collaboration with you as well and other partners. The other instrument would be guarantees, right? Guarantees, and it's so valuable. And this is a work I was doing at the World Economic Forum many years ago in 2005. So it was called the Financing for Development Initiative. And the objective was to get 5 MDBs in the same room as 5 investment banks. And the report was called Building on the Monterey Consensus, the Untapped Potential of Development Finance to Catalyze Private Investment. And back then, 15 years ago, we said the issue is risk mitigation. So the idea is, should public capital be used more for guarantees than direct loans? So because once you guarantee it, then additional capital can come in. And we are doing this very interestingly now, again in solar, but in Gambia, we have guaranteed sort of a $12 million solar plant. And we're doing this with UNDP, our close partner organization. So guaranteeing projects in the LDCs will enable the bigger size projects to happen by attracting additional capital. A third point I'd like to make is our focus on digital. So I think the digital field is very exciting and growing, and even in the LDCs. And it's a way to leapfrog physical infrastructure as well. So we have very, very intense focus on that. And one example there is in Zimbabwe, we are creating an MSME platform, kind of an exchange. It's not a stock exchange, but it's an exchange where we use data from mobile operators on the to give the MSMEs their credit score and other information that makes them more investable, and the investors could have that data. So an MSME platform in Zimbabwe based on mobile operators' data, and that could be expanded to other countries. So those are 3. A couple of other things, working with impact investors like Omidyar Network and others that want to take what we call the pre-frontier risk. So our countries are even beyond the frontier, the pre-frontier. But we don't call them the least developing countries. We call them the most attractive markets, the last frontier of development. And so working with some of those. So working with the GIN, which is the Global Impact Investors Network, looking at which of them have the appetite for those markets, and then sharing our pipeline with them. So a strength, obviously, we bring to the market is we are around 300 people in all, and 250 of them are on the ground, spread across most of the LDCs. So we can do better sourcing and monitoring and sort of create that pipeline. And maybe lastly to say, I really believe in this concept of global roadshows, virtual for now, between the LDC, ministers, planning, finance, ecosystem, connecting them on the same table with the donors, but also with institutional capital. So I think it should be a 3-way roadshow, because I feel you need the interaction, the understanding, the education to understand those markets. Otherwise, those two sides don't speak, perhaps, and therefore the real and perceived risk could be discussed and evaluated, and what will it take might get an answer. So those would be 4 or 5 points I'd like to make. Thanks.
Thank you. I think those are all very helpful points and approaches that we can use, and they're all extremely collaborative. So individuals from the government, the private sector, DFIs, MDBs, and impact investors can at least find some of those approaches that would work for them. So I appreciate those comments and examples. Magnus, I'd like to return to you and get a sense of what return risk ratio would be required to get capital to flow to these countries. What do you see as the minimum ticket size for you to invest in? And also how we can use blended finance from your perspective to help address investment risk in LDCs?
I think when it comes to risks, it's also the other side of the equation is also return. So one kind of consideration that has been floated in the discussions, of course, that there should be a match and not a mismatch of risk and return. So one way, I mean, if you do look at blended finance solutions, they could actually, result in that you reduce the risk too much, and therefore, kind of the return profile is not matching anymore. So you need to also be attentive how you do that. So you have also ways of actually for investors to actually capture risk, because there's a lot of investors who are eager to take risk. I mean, we are eager to take risks in a way. That's why we seek these markets, because we do think that kind of finding the right companies and finding that's where we really build value and so on as an asset manager. So I think there's no kind of direct recipe that this is kind of the exact risk profile we're looking for. It is always a balance of a risk versus the rewards. And then when it comes to the size, I mean, if it's very tricky to give a rule of thumb there. I would say, I mean, it's really how the supply side look like, right? And how you construct your investment thesis. I mean, as an asset manager, what we do towards our stakeholders, investors, and fiduciaries, I mean, we do come with an idea, and then depending on what targets we see, that's how we formulate the idea. But maybe I could also revert to another example that kind of came to my mind when it comes to kind of managing kind of the investment risk. And I think that's where maybe asset managers with a local presence could actually be one good partner in order to do that. And I recall in the late 90s and early years of 2000, I mean, we had initiatives in the Baltics, right? Not completely comparable, of course, but where we, together with a Swedish development organization, could basically team up in a joint management organization, where this organization could actually was a participant in our fund as an investor, but also a very key contributor through their network and advisory boards, and also evaluating various investment opportunities. In this particular case, it was completely directed towards SMEs in this region. And it was everything from kind of small bakeries to small startup fashion companies or whatever. So I think there are ways of being quite creative in the way that how you actually structure the management locally to also tap into the kind of financial engineering and how asset management evaluate investments more from a kind of traditional risk return profile. Then one other observation is, of course, that, I mean, now we're talking about private capital, and maybe when we're talking about the LDCs, that's what comes first to mind. I would also like to stress the kind of the more long-term view to also develop institution and the legal systems and the strength of the institutions locally, so you can also build up this ecosystem for markets to step in directly without going through the blended finance solutions and so on. And I don't think we should kind of lose sight on that. And again, to drawing the parallel for Eastern Europe, I mean, it completely in the 90s, it was completely disconnected from the financial system, but where you had this kind of incentives with the European membership and so forth, and get access to the global financial markets, gradually you could, strengthen your institutions, you could develop your legal system, and therefore you could see banks moving in, auditors, all these intermediaries who all together create this essential ecosystem locally. So maybe it's too far away, but I would like to stress that, we should not lose sight on that aspect as well.
Thank you so much for your answer. I think it's very important to look at the local systems and working with local asset managers and sources of capital in combination to develop solutions that are tailored for each market. I want to go back to you, Tarja, and ask a question on the types of financing mechanisms that would allow us to make more investments in LDCs. What capital structures should we look at, the level of concessionality, what role could blended finance specifically play, and what are some of the other forms of de-risking support that would help attract this Main Street private capital to LDCs, and where you've seen that be successful?
Sure. Again, I think it's really important to delineate the different types of projects and the pools of capital. From a private investor standpoint, and again, I'll speak from an infrastructure perspective, the focus is on stability of revenue, and how do we get comfortable that that off-takers will pay, government obligations will be paid. It all comes down to that level of stability. On the debt side, it's about getting that baseline repayment, but from an equity perspective, we want growth, we want value accretion, and they're sort of two different challenges. And so, but both of them are crucial. You need, there are some aspects of development that require debt capital, and it's easier to use a form of a sovereign related public borrowing with different forms of wraps, etc. And then there's the private equity type perspective, which I've been on sort of both sides of the spectrum. But the challenge with frontier markets is that even the public sector, even a project that has a sovereign guarantee, will struggle to raise capital. So you're coming from a very low base. We're not talking about investment grade or near investment grade African nations. We're talking about or frontier developing markets. You're talking frontier markets that would not be able to tap into the global financial market on their own because of their weak institutions, because of their track records and things like that. But we do have great examples over the last 4 years where this growing network of DFIs, both international and African, so African DFIs and international DFIs, are working together to strengthen frontier market, frontier government institutions, systems, as well as their guarantee to create a bankable loan framework. And I think the other thing that's been really interesting, to touch on Magnus' point, is even a level of loans being converted into a syndicated form of bond. So a sort of a repack structure that's happened off some LDC paper. And again, it's all just in recent years where by virtue of partnering with DFIs, both African and international, you're able to create these sort of synthetic type bond structures of an LDC borrowing. But that's not private. That's basically dealing with the sovereign angle or the public angle. The next big challenge is how do we channel capital into the private sector? And how do we make an investment case? So that would be in my neck of the woods now. And how do we get folks to see an investment opportunity? So the first step is stability of revenue, which is provided again through different forms of guarantees on offtake and the like from an infrastructure perspective. But it's important that we also have a visibility into growth and stability of the opportunity. And for that reason, we tend to look at essential services and to what extent that opportunity is really critical, that a project or investment is really critical to the government so that it's so strategic that it would not fail. But again, this is where DFIs is so much rests on DFIs because the immunities and privileges and the special relationships that DFIs have with the government create a very valuable interface for the private sector. In several projects that I've invested in, the role of the DFI and their ability to interface with the government and put pressure on the government is crucial. And so beyond the guarantees and the instruments, even the presence of that network of MDBs can be quite useful. There's the need for technical assistance. I think across the board, project preparation and helping sponsors to shift from ideas into truly bankable projects. That there's a great need for that. But a lot of bankability comes through structuring. So how do you enhance the capacity of a municipality to structure an agreement with a sponsor? That's capacity that's needed both at the municipal level, but also at the sponsor level. So there's a lot of technical capacity requirements as well as project development capital or grant capital that's also needed to take projects to a point that they can even be investable. And then we've talked a bit about aggregation, but I do want to touch on an element around exits. As a private equity investor, and the conundrum across the private equity landscape in Africa is about exits. Debt has historically done better in Africa, and LDCs are not far behind. The frontier economies are starting to issue some half-decent paper. So we're having a few success stories. But we really continue to struggle across the board with exits. And one of the things I think we need to start thinking about is how to use blended finance for exits. So to what extent can we use refinancing facilities, different forms of performance-based facilities, so that equity can basically get taken out and can get recycled? So we need to think about new models for creating equity value beyond looking for a market to IPO, because we're not going to have IPOs as an opportunity to exit investments in these types of markets. And so, there's a great initiative right now. The World Bank has a performance-based grant system for micro and mini grids. And it's actually functioning. And, the issue is that it's supposed to attract capital. We're still trying to figure out how to deploy some capital into the space. But the point is, we couldn't even look at those deals if we didn't have that tranche. But the fact that the tranche exists allows the deal be in the pipeline in the first instance. So now we've got to make sure that that tranche works and that the project works. But these are the type of nuances that we're moving toward around how do you get that liquidity back out and needing support for that.
I think those are excellent points. And before I go to the next question, I just have a follow-up question. This is a question I saw in the Q&A, and it gets to exactly what you were saying about that results-based financing. And the question was on the amount or the percentage or how private capital can be best utilized in these SIBs or results-based financing initiatives. And so just wanted to see if you have any additional thoughts on that and perspective of how to bring in private capital and how it could be best used for results-based financing.
Yeah, results-based financing is interesting. I have to confess, it's one of the first times that I'm actually trying to structure towards results-based financing. And I think that the key takeaway is that the investor needs comfort that as long as we perform, as long as we're happy to take operating risk, but we need to be sure that payment is going to be made. And so it's very important that results-based financing actually has a registration component where that project is registered such that the equity investor can invest and take only the operating and delivery risk versus the question mark as to whether the project qualifies. So I think that's a very important part of it. The second is an allowance for recycling, and to what extent, recycling is not constrained. But I think another important consideration is to what extent the recycling is factoring in, the performance-based facility is taking into cognizance returns. So a lot of the time, it's really more of a one-to-one where you're taking out a fixed amount of capital. And what that implies is that you need the results-based facility in many cases, especially in more of the very small projects, to take out quite a large part of the capital. And so what you're trying to get to is with a project, results-based financing, taking out large portions of the capital structure, but over time, taking out lower and lower portions of the capital structure because the project is bankable independently. That's where you're trying to get to. But right now, we equity investors want the results-based capital to take out such a significant portion of the capital because we feel we've done our job by virtue of taking us through the operating and delivery risk portion. So that's kind of like the tension between the two pools of capital.
Thank you so much for that. And as I've been listening to each of you, I've been taking notes, and there have been some really good examples and techniques and tools and mechanisms to use. And I'd just like to pose the question to each of you as well, if you had any particular reactions or comments based on some of the things that you've heard from the other panelists today. So Magnus, I'll start with you and see if you had any reaction from what you've heard so far.
Yeah, I mean, just going back to Tarja's point there regarding private equity, pure private equity, so on, and the need for an exit in a way. I think that is really the challenge, and that is kind of this risk, which is very difficult to manage if you go in directly, and maybe that's also why I'm more leaning towards looking at pool vehicles. Maybe basically debt instruments is a better instrument to get scale and pool and tap into capital where you could have more larger tickets to be allocated into a joint pool, but where you have intermediaries. Those could be the MDBs, or it could be kind of asset managers, or combination of that, who cannot channels this into these projects, but where you not expect an exit in near term, and where you could kind of get that exit risk, so to say, off the table, and where you could recycle this capital within the MDB or within those kind of asset managers. You need to have that kind of longevity, this kind of evergreen kind of structure, so to say, where you can recycle it. Because I think, just looking at those more challenging countries where we have been doing private equity in the past, that is really the key challenge, right? You go in there, you see the opportunities, but how the opportunities will look like 5, 6, 7 years down the line, that is really where it gets quite blurry. And that's also what kind of make also investors to hesitate in the end. So that's kind of my thoughts on private equity, that maybe those kind of more pooled kind of structures are better suitable in a way.
Thank you. Preeti, did you have any reactions to any of the comments or statements from the other panelists?
Yeah, thank you. And I totally enjoyed all the comments. But I know Taria, from a background, I find very interesting that her fund is invested in by some of the Nigerian pension funds. And I quite like that example, because I want domestic local capital as well to be the investors, because I think they would understand the markets well, and maybe also to lead the investment in some ways, so that to show how the market works, the understanding would be good. So that, and of course everything else she said about the investment and the guarantees. And for Magnus, I mean, if you are taking the risk and you have private equity, I think the idea would be to showcase and highlight these examples so that we can get others to follow, and also encourage the LDC countries to make their ecosystems ready to receive more. So I have a bit of a statement to make on the social impact bonds and results, but I don't know, in the interest of time, I'll leave it for now. I'm trying to answer some of the chats just by an email so people could follow up, if that's okay. Back to you, Dia.
Sure. Thank you so much for that. And I guess, Taria, I'll turn it over to you and see if you have some reactions or statements based on what you've heard from the other panelists.
Yeah, I just want to tell Magnus that we're a nice intermediary in Nigeria as well. So I have to have a follow-up conversation. I think we need to start thinking about the risk spectrum and capital allocation to the risk spectrum. I just want to touch on that. In that, the spectrum across project development, preparation of projects, construction risk phase, early operation phase, and stability. I speak as an infrastructure person, but it's definitely a pathway. And I think one of the challenges historically is that we've always tried to solve for a capital that can go into the entire spectrum. Can we finance an infrastructure project, a 30-year profile, a 25-year profile? And the reality is that, there are pieces of the spectrum that are more suitable for certain players. And we may actually find that it's more efficient to get projects done with one pool, get it to its next phase, hand over to a different type of party, finish the construction phase, and then start taking out the capital with, more relevant parties. And I think that that's going to help. But a key success factor for that is domestic capital. Because the idea of financing long-term investments with foreign currency is ultimately unsustainable. I think the gaps are significant enough now that when we're taking up an essential project in a frontier market, you're doing sort of the first major IPP, first major breakwater for a port, things like that are so strategic. Absolutely, let's get a sovereign guarantee, let's do the backing, let's do the project. But over time, we need a much more sustainable system that involves less exposure to foreign currency, especially outside of Francophone Africa, where we don't have a peg. And so we only do that if we have domestic currency pools of capital. And so we need to start, and it's a broader issue, at least in Nigeria, we have a pretty developed domestic capital market and domestic pension fund market. But we also need to start supporting the development of domestic capital markets across nations, because it's so fundamental for that long tail of investments and being able to do this recycling. Because we can use some of the more sophisticated capital that can take some of these other risks. But once a project is stabilized, why use this? Why use the dollars and have all that exposure? It would be so much better if there were domestic sources could then create a more sustainable flow. So we need to start thinking about that. But the reality is some of these countries just don't even have the domestic pension fund sector that's developed enough. And there needs to be a lot of work to help those sectors develop. And let's also think about aggregating capital markets. So we need, there's regional integration for trade. Let's also think about regional integration for capital markets.
I would be happy to just tag on to that line of reasoning because I think you really touched upon the key here that, okay, you go in and you could invest temporarily and so on, and then the capital goes out of the country. In the end, where you would like to be is, of course, that you build up the local ecosystem. The local ecosystem could be established to start with in order to accommodate our needs, the international capital moving into the market, right? So you're sure that you have the legal framework in place, that you strengthen the institution, the oversight, so you have the banks and other ecosystem participants moving into the market. That's step one, and that could be fueled and pushed by international investment. But that should not be the end. It should really be the starting point for developing the local capital markets, where you have the local capital staying in the market, where you could start building up pension funds, market participants. So you could keep it and you could start recycling it, and also being part of the kind of global kind of financial system in a way. And I think that is what we have seen in our markets, how they have developed from nothing, but then foreign investors moving in, foreign investors are pushing banks into the market. You have the auditors there, you have the lawyers there. You also push policy on legal framework, making sure that you have all this governance bodies and checks and balances in the systems. And then also, of course, with the challenging, also with making sure that these structures are robust enough, and then in due time you will get the required participants and the liquidity in the local markets, and then all of a sudden you have had a very kind of positive spin on the of the development of the local market. So I think that should really be the end game as I see it.
I have a follow-up question, and I'll take point of privilege as a moderator, because I think this is a very interesting and important point. What do you see that, DFIs, MDBs are not doing that they could do to help support and develop the local financial markets, to bring in or crowd in the local institutional investors and pension funds? I'd be very curious for the thoughts of all or one of you who'd like to answer that question.
I'm super happy to comment on that. I have a lot of thoughts on that. It is one of those kind of overarching development questions, right? It's really how do you basically direct, aid, concessional investments. It's also about it's not only about capital, it's also kind of sharing know-how and making sure that you could create your best practice. In a way, you see LDCs leapfrogging in kind of telecommunications. Why can't they just leapfrogging when it comes to the financial system? So they don't need to go through this arduous development that we have been going through for the 100 years. They could leapfrog into something which could be super efficient from day one, if you kind of put it a bit bluntly, right? So I think it's, when it comes to the ecosystem, which is so important, I think it's equally as knowledge sharing, making sure that you invest the right resources, support the local governments, that they actually see the utility in building up and strengthen the institution. Anti-corruption work, super important, right? I mean, that's one of those things where you would need to feel super comfortable as a market participant that you could rely in the robustness of the local markets eventually. And it's just, if you just have a number of failings, that could be devastating. So I think just building the right institutions, the right legal framework, and the right culture, then you have kind of set a good groundwork for kind of building the rest of the building blocks.
Yeah, let me just touch on something with respect to sort of the success cases and the trajectory. I think the first is just establishing a savings system and having a pension fund system that is beyond the public sector, because a lot of governments have some form of pension fund sector. And so creating that framework for a broader pension fund sector and then a more functioning capital market. And I think there's two key things around that, which is around the policy as well as the law. I think there's been so many bad experiences in Africa after certain, many African countries went through this period 25 years ago, 30 years ago, where there were sort of civil unrest or issues like that. And there's always a concern with savings in that type of environment. And what's been great in a country like Nigeria is that the pension reform was an act, and it's part of law, and it cannot be repealed. The capital cannot be taken or used at the whims of the government. So it's very robust. And so I think DFIs can do a very good job to convene African success stories and other emerging market success stories of how the domestic capital markets were developed and how those policies can be applied, and provide support for the laws as well as the policies to support the reform or the establishment and the growth of the domestic savings system. So there's a great role that DFIs can play, but we have examples. The issue is just to get all these countries into a room and to also leverage on precedents and past experience. There's really no reason to recreate the wheel. So I think that's one thing. Now, when these markets or these domestic savings markets are set up, the first thing is all they want to do is finance treasury growth. It happens in all the markets, whether it's Latin America, whether it's Africa. The pension fund systems are so careful and cautious that it makes sense that they would be most comfortable with government bonds, and even that system in itself needs to stabilize. But again, over time, DFIs have a great role to play in encouraging domestic capital into private alternative assets or equities or infrastructure, etc. And so, for example, in our fund, in fact, even in the Nigerian policy for pension funds, they've actually sort of encouraged the pension funds to invest in equity funds that have a DFI, because that should give them comfort that the governance is in place. And so they're sort of encouraging policies to help them allocate. So you move from having just baseline a sector, and then the second stage is how do you get them to allocate to parts of the economy that are valuable. So that's kind of where we are now. So now we have a sector, it's just not allocating optimally. And so DFIs are doing some interesting work with setting up guarantee funds for a particular sector, so that we can issue bonds that have certain guarantees or enhancements so that it'll be deployed. And it's really more of supporting with allocation now that our sector is about 12, 13 years old and is a bit more advanced. So those are some things I think I'd like to touch on.
Yeah, I'll join in since it's such an interesting question. Two very quick points. So for us, obviously, we feel where we are in the development finance architecture. So we are in that last mile and looking at the smaller opportunities. But largely, DFIs and MDBs, they could give lines of credit, right, to the banks, domestic banks, or guarantee certain portfolios so that the interest rate comes down as well in these markets. So we are a small entity, but we've done our own loans and guarantees and from our own balance sheet, and brought interest rates down to 15% versus 26% in some cases. So I think that working through the domestic banking system. And also another thing is this local currency financing, going back to Teria's point, we need some structure where this can be taken off the return, right? Because if we earn 10, 12%, then by the time you hedge it for 6, 7%, the return is not there. So we're saying these markets actually have a lot of return. So we need maybe public capital, patient capital to find a structure that can take that out and subsidize that in some ways. Thanks.
Thank you. And I have a follow-up question, because I think this is really important as we discuss SMEs. And this was mentioned earlier about technical assistance and technical development. One of the questions that came across are, what are ways that UNCDF is working with these smaller companies, for example, local mobile money companies in the digital economy that are very innovative SMEs? Are there ways that you would provide support to strengthen their capacity and help them develop as a business, either non-financial or financial support?
Absolutely. So as I mentioned, perhaps the best way would be our local contacts on the ground. So we pretty much have representation in 31 of the 46 LDCs, but we also have regional hubs in Dakar and in Uganda, and then Bangkok and Asia Pacific. So I've been sending the contacts of the head of the Dakar office to some of the questions. But largely, absolutely, that would be our mandate under the inclusive digital economies. And we would use the the softer grants and TAs. I mean, the way we've done it, for example, let's say in Uganda, on the policy side, we would give a grant or a TA to the government to develop a policy for telecoms to come in. Sometimes we work with them on specific gender inclusive policies, for example, needs of women. For example, we find women send smaller but more frequent remittances, and men send larger and less frequent. So, ways of gender specific policy as well. But then on the SME side as well, I mean, we will need, we'll need a business plan, right? But we could seed that. So there was a question earlier in a panel of informal sector. So the informal, if they could have entrepreneurial abilities, we could certainly look at the funding of that. And, it's not totally digital, but it's sort of. So in Uganda, we seed funded and helped the business plan of a company called Safe Boda, which is kind of a motorcycle taxi company in the Uber of Uganda. And during COVID, they pivoted to supplying food, delivering food. And I believe now, they matured to a stage where impact investors and other Uber type of companies are looking at them. So I think we're helping grow the market. And certainly the question could be posed to our office, and that would be best. And of course, then we have the New York office here, and the inclusive digital economies is staffed out of here as well. So.
Thank you. And we have one last question, and I think before we do our rapid fire round, and I will open it up to all of the panelists to make a few comments. And this goes back to results-based financing. It was a follow-up question, and it was regarding what they could do to bring in private capital. And again, what percent of private capital they should look at bringing in for results-based financing projects. So if there's any kind of thoughts or response to that question, it'd be greatly appreciated.
So I could take a crack. It was perhaps some of that, the moonshot ideas as well. But I was trying to explain that, the results-based, the social impact bonds originated in the UK market. Sir Ronald Cohen, early implementers of it. And there's social finance. It's a network of entities created under his guidance that do a lot of that. But basically, in the sort of developed markets, when local governments have money, funds, then they service say, let's educate girls, right? So that is given to a private capital. Private capital invests in that, and based on the results, it's the local government that pays back. So government is sort of paying for a service executed by the private sector. And the thing is that the private sector puts up 100% of the money, and then it's paid back with interest if the results are met. In more developing countries, we find that the philanthropies are the ones that are paying the outcome, as you know. So it's called then the development impact bond. But I just wanted to add, I've seen a recent innovation by Credit Suisse on a Rhino bond. So it's a $50 million bond bought on the capital markets, 5-year bullet. And it's implemented, let's say, by a zoological institute. It's about preserving the number of rhinos or growing them. So if currently from 2,300 rhinos, they go up to 3,000 in 5 years, then you get certain 5% return. And if it's more than that, then another philanthropic entity pays more than that. But in both cases, it's still kind of a public capital that's paying back, but it is being issued in the capital market. So I think it's that one step up. And what I'd like to propose is actually, if human development, the cost to take somebody from extreme poverty to basic standard of living captured by SDGs into a quantifiable amount, if that is kind of a tokenized ownership, there's tokens issued which are traded in the capital markets. So, it could be, let's say, a gender specific token, and you take what would take to take, certain women from extreme poverty to a certain basic standard of living, and that becomes an investable opportunity. And the value of the token, it has a value when you hold it, and the value goes up if the results are met next year and 3 years and 5 years. So these become then market-based impact or results-based financing, and that's the direction I'd like to go in. I'd like to see capital markets evolve into having human development as an investable asset.
I think that's very interesting. Go ahead, Taria. Please, I'm very interested to get your comments.
I just wanted to make a very small addition to this, which is around education. That results-based financing, at least in the, let's just call it the African private equity landscape, which is where I operate, just needs a lot more education. And I think it's very important that when these programs are set up, that there really is a thinking as to how, I think Preeti mentioned, how does that become an investable instrument for the private sector? This is one of the issues we're having with some of the results-based opportunities, is that we actually need some support with how to make sense of it as an investable instrument. And because of the work we're doing in trying to position infrastructure as an impact asset class and doing work in the low carbon space, we are specifically trying to figure it out. But there's not a lot of capital that's looking for challenges. Capital wants things to be easier. And so when we have results-based financing, there really does need to be a lot of support for the private sector to be able to figure it out. And that shouldn't be left undone. Markets are a lot less efficient than you would think. And so I think there's sometimes the assumption that once we place it in, the market will figure it out. And there's not as much of that happening. And I think the private sector does need help with it.
Thank you for that. That's very important and reflects the reality, as you mentioned, in some of the markets that we work in. So I'm so appreciative and thankful. I think this has been such a dynamic conversation. And I'd like to close it out with one last question for each of you. We'll do a rapid fire round and have a couple of minutes of a response. And the question is, what is your number one recommendation for a concrete solution or policy that should be taken up to scale finance for transformative investments in LDCs? So I'll start with you, Preeti. We'll go to Magnus, and we'll end with Taria, if that works.
Thank you, Dia. I think I'll continue on my theme and maybe try to explain it more. So my sort of number one recommendation for current aspect is that we must ensure capital serves humanity, right? And its purpose, the purpose of money should be about establishing humanity and planetary welfare. And the reason to do that is we've seen COVID hit the externality factor, right? Now it's not about, oh, somebody can be rich and somebody can be poor. It's if there's too much inequality in the world, the externalities hit everybody. So COVID is one unfortunate example of that. So the concept I was trying to explain was there'll perhaps never be enough, certainly official development capital or the private capital as well, until we make some of the development topics investable. So just take this concept of human development token. Private capital should invest in human development, but it should be a quantifiable, agreed upon investment strategy. And it comes from that carbon credit market. It has to originate from that effort that humanity made at that time of the carbon offsets, the pricing, and apply it to the different sectors. So one could be the gender sector, but overall ensuring basic standard of living and making that investment from extreme poverty to basic an investable instrument, and taking perhaps the idea of tokenization, which means fractal ownership. It's not necessarily has to be on the blockchain, but the concept of fractal ownership into a human development or planetary development, both are equally important. So I would hope for me, the capital markets look very different in year 1 and 2 next year and the year after, if we can have more of those things, let's say like the Rhino bond, we see more of that in the market. Thanks.
I think it's super inspiring to listen to you, Preeti. I think all this kind of creative work and all this product development ideas, that must simply just continue as it does, and there will be new concepts getting more and more traction and establishment. But I think on this question, what would be my key recommendation here now? I think I would like to do the kind of the full circle here and go back a little bit where I started off, because in order to kind of get this catalytic impact now, I think we should really focus on what's out there now and tweak what's already kind of very recognized and established. That's why I do believe that the bond instrument is so established. It also taps into a very large pool of capital, and where it's a lot of demand out there. We have seen bond issues being oversubscribed 2-3 times just for this kind of instrument. And if you just tweak it, or if you have these MDBs being the intermediary issuer, I mean, these issues are being sucked up immediately by the financial market. So there is a lot of demand out there. There are already functioning instruments. So I think it's just a way of tweaking this and making sure that the MDBs are channeling this capital in the right direction, where you could actually go into project finance and private equity. So that would be my key recommendation.
So I really would have preferred that Preeti had the last word, because I think the comments you made were just so powerful. But I'll build on that, because I do think this issue of capital and purpose, and the very important shift that capital needs to make around what it can do to change the world and change the way we live and change humanity is really becoming quite central. And maybe I'll just say that as you were speaking, it occurred to me that, is it possible that this wall of liquidity we have, and again, all this low rates and low yields, is because, we need more, the capital needs to have more use. It needs to build more value. And the challenge is that capital is building for capital's sake. And we need to find a way to deploy capital so that it's actually having impact and generating return and solving true problems that are facing us. And it appears that we're not doing enough of that, which is why there's so much capital building. And, you know, we have this liquidity wall because it's sort of, it's not innovating fast enough to solve the problems we're currently facing. And so I think that some of the points that you made, I think are very important for us to think about and for us to start to implement in our various markets, really to think about this liquidity wall and these capital markets as leaving, you know, really leaving a lot of value on the table for how you know, the capital can make an impact and actually change the world. So I really appreciated your comments, and you really gave me a lot to think about.
Terry, your comments were equally inspirational. Capital should have value. So absolutely.
And I don't think between the comments of the three of you, so well said, and how we should look at, use, and implement capital to have real impact for human development and to change the world. There's nothing to add to that. I think it's very profound. And I'd just like to thank you so much for your time today. I also want to thank the audience as well for joining us for this very fruitful and informative discussion. So thank you, everyone. At this point, I'll pass the floor to Laura at the UNCDF to give us some final words.
Thank you, Dia, so much for leading this discussion. Thank you to our panelists. It really was a rich and detailed and technical, and it's clear that you have not only the knowledge, but the experience in having done this and working in these areas, and we really appreciate you sharing that with us today. Thanks very much to all the participants, as Dia said. We look forward to continuing to support and engage in the LDC5 process for the rest of the year, and look forward to the outcomes in the beginning of next year. Thanks very much.
Thank you, Laura.
Thank you, dear, being a great moderator.
Thank you all.
Take care. Thanks, everyone.
Bye. Nice meeting you all.
Thank you, Laura.